Rick Santelli joining us now from Chicago with the bond report. Rick, I went on it was like a 10-second mini rant yesterday, but the gist was basically this. The Federal Reserve can say and do what it wants. The bond market is the boss, and the bond market is going to do what it wants, and it wanted and wants clearly to take interest rates, if not higher, not lower.
Yeah, it's a very interesting dynamic, especially for those that are in the current administration or those that are looking towards housing to be the one part of the economy we'd like to see juiced up a bit because it's not cooperating. The market's not cooperating. That doesn't mean the Fed can't do quantitative easing again in the future where they manipulate long-term rates by buying the securities, but the market could even push back on that. Let's start at the beginning. Okay, here's 2s and 10s, the close the day before the Fed cut in October. The 2-year was at 349. The 10-year was at 398. Obviously, they're both higher. Let's go back to the pre-September cut. So we'll go back to the close before the rate cut on the 16th of September. You can see both 2s and 10s indeed are higher. And as we sit right now, we're up 10 basis points on the week in both 2s and 10s. Look at the dollar index. The dollar index, Fed's eased twice. Dollar index has basically gone from close to 97 to getting ever closer to testing 100. So really, this is a case study in the realities of how much the Federal Reserve can do without quantitative easing. And let's do remember, with the entire globe really encased in debt, doing quantitative easing could have a high price tag. Ultimately, the Fed's balance sheet was $9 trillion. Now it's 6.6. So they made a lot of progress, but that's still well above where it was before the credit crisis when it was under $1 trillion.